Up now, we have Forum Daily's market update with Catherine Murray.
Thanks, Nima. Hello, everyone, and welcome to your weekly market recap. I am Catherine Murray. Well, we are watching a mixed picture in the markets. U.S. markets are mostly higher today, following some choppiness yesterday on the back of the U.S. Federal Reserve. And the TSX is trading a little bit lower. It was up a little bit higher yesterday. So again, a bit of a mixed picture. Delving into some of the details here, the U.S. Federal Reserve, very much as expected, did not raise rates yesterday. So they did pause. That's actually the first pause that we've seen since they started raising rates well over a year ago. And keep in mind as well that this has been the tightest and fastest rate hikes that we've seen in about 40 years. So about 500 basis points of tightening. So many people were calling and hoping that the U.S. Federal Reserve would in fact pause so that we can make sure we see what the effects are as it relates to the liquidity and the tightening of the market, and in particular, the lending market. So that did happen as expected. But what was a little bit unexpected is that the dot plot, so Fed expectations for what happens next, is indicating that we will see two more rate hikes in 2023 to the tune of 50 basis points. So it's a little bit of a hawkish pause is how they're terming it in the media today. And interestingly as well, investors are still expecting that the U.S. Federal Reserve will actually cut rates in 2024. Why are they doing this? Likely because core inflation is still high. It seems sticky and higher for longer. I think that should be a takeaway. And also, of course, in the U.S. a week ago, we had a very, very strong jobs report. So given that, it seems as though they still want to be very much data dependent. What's been interesting as well is that the U.S. market has been very resilient, and we've actually seen a broader participation in the market since the debt ceiling was alleviated. In other words, we're seeing more players come in and pick up some stocks. You're seeing a rally in the small and mid cap, so mid space. That tends to be a bit of a positive. Interestingly as well, Goldman Sachs did increase their price target on the S&P 500 to 4,500 from 4,000. Interestingly as well, they see a 25% probability of a recession, whereas the consensus is still estimating a 65% chance probability of a recession. But what has been so interesting is that we've all been waiting for this recession for about 14 or 15 months, hasn't existed. So there's more people, I think, thinking that maybe we'll see a bit of a soft landing. Economic data might support that. We did have retail sales out in the United States today showing better than expected results, but mixed manufacturing data. The Philly Fed manufacturing data did contract, whereas Empire manufacturing expanded. So a little bit of a mixed picture there. We're also seeing earnings perhaps coming in a little bit better. Of course, the major earnings have been completed, but we did hear from home builder Lennar yesterday after the closing bells, and they beat across all metrics. And aside from that, you are seeing some analysts upgrade stocks. Kohl's, for one, TD Cowen upgraded the stock, positive on the new CEO there. And then also Domino's Pizza, that stock's moving higher to the tune of 5% today. That was upgraded over at Stifel Nicolaus. They are seeing some stabilization in sales. But bottom line, as it relates to the markets right now, the bond market is still pricing in a recession. We still have an inverted yield curve. I did do a speech in Calgary last week, and I pointed out some really interesting research that I've been reading, which indicates, and this is a very out of consensus call, that a steepening yield curve, in other words, the lower rates for longer maturity, is actually stimulative for the broader economy because most people borrow on longer dated terms. So that's an interesting take as it relates to this inverted yield curve. In other words, it won't signal a recession this time. In fact, it will be stimulative. Away from that, as we look at the TSX today, most sectors are trading lower. We certainly have underperformed those U.S. markets on a year-to-date basis, pretty much flat, whereas those U.S. markets are up double-digit territory. The likely reason for that is because we have had some setbacks as relates to the China reopening. Away from that, the BOC is expected to hike next month. Interestingly, we've seen Stats Canada show that the savings rate is actually the lowest we've seen since the fourth quarter of 2019. In other words, inflation is in fact impacting many households today. In other words, their dollars have to go to spend on higher food costs. The CMHC is saying that housing starts are actually down by 23% in May. The BOC, Bank of Canada, has said, though, that we've seen some stabilization in the housing market, and that was one of the reasons for raising rates last month. Just one item on an interesting stock here. European Residential REIT is a subsidiary of Cap REIT. There's a report out saying that Cap REIT is looking to sell their $1.9 billion Dutch portfolio, euros that is.